Ever feel like your money just doesn't go as far as it used to? It's not just a feeling in your head, it's a real economic phenomenon happening all around us. You work hard for your money, but month after month, it seems to buy a little less. This invisible force eating away at your wallet is called inflation, and understanding it is crucial for navigating your financial life. Let's break down what it is, why it happens, and how it quietly affects everything from your daily coffee to your long-term dreams. So, what exactly is inflation? In the simplest terms, inflation is the rate at which the general level of prices for goods and services rises, which means the purchasing power of your currency falls. Imagine you have a 50 bill today. You can fill up your shopping cart with a decent amount of groceries. Now picture that same $50 bill a few years from now. Due to inflation, you'll find that the same amount of money gets you a noticeably less full cart. The money itself hasn't changed, but its value, what it can actually buy, has decreased. It's the reason why your grandparents talk about buying a movie ticket for a quarter, a price that seems almost unbelievable today. This gradual decline in purchasing power is the core concept of inflation. There are several key drivers behind this economic process, but they generally fall into three main categories. The first is demand pull inflation. This happens when there's too much money chasing too few goods. Think of it like the release of a highly anticipated new smartphone. If everyone rushes to buy it but the supply is limited, stores can charge higher prices because the demand is so intense. On a larger scale, if an entire economy has a lot of spending power but not enough products and services to go around, prices will naturally be pulled upward across the board. The second major cause is cost-push inflation. This occurs when the cost to produce goods and services increases. For example, if the price of crude oil spikes, the cost of gasoline and transportation goes up. A business that ships its products will have to pay more for fuel, and to protect its profit margins, it will pass that extra cost on to you, the consumer, by raising the price of its goods. Similarly, if wages rise significantly without a corresponding increase in productivity, companies may increase prices to cover their higher labor costs. It's a domino effect, where rising costs at any point in the supply chain get pushed onto the final price tag. Finally, there's the expansion of the money supply. When a central bank prints more money, it increases the total amount of currency in circulation. If this isn't matched by economic growth, the value of each individual dollar decreases, much like adding too much water to a drink dilutes its flavor. The effects of inflation aren't always obvious, but they are significant and can have hidden consequences for your financial health. One of the most direct impacts is the erosion of your savings. If you have money sitting in a low-interest savings account, or even worse, hidden under your mattress, inflation is silently chipping away at its value over time. What could buy a car 10 years ago might only cover a down payment today. This forces people to think about investing, as leaving cash idle means it's guaranteed to lose power. Furthermore, inflation directly increases your cost of living. The prices of everyday necessities like groceries, gasoline, rent, and electricity all tend to rise. Your paycheck might stay the same, but you'll find it harder to cover your monthly expenses, leaving less room for discretionary spending or saving. This can also create widespread economic uncertainty. When prices are unpredictable, businesses become hesitant to make long-term investments. They might delay building a new factory or hiring more employees because they can't accurately forecast their future costs and revenues, which can slow down overall economic growth. Inflation is a complex and powerful force that shapes our economy and our personal finances in profound ways. It's not just an abstract number you see on the news, it's a tangible reality that affects your budget, your savings, and your future. By understanding its causes and effects, you are taking the first and most important step toward protecting your financial future and making smarter decisions with your hard-earned money.